Welcome back everyone. Today we will talk about the dynamic analysis of open interest. In the previous video lesson, you learned that the static analysis of open interest is a snapshot of the market situation at a given date, but it tells us little. To refine our reading, we need to study the evolution of monetary positions. For each strike, and for each type of option, call and put, we are going to calculate the difference between the open interest on the most recent day, Y, and the least recent day, X. The result is algebraic for each strike. It suggests us what is probably happening on the strike itself and how the market expectations and the operator's sentiment are changing. Let's see some of them. An increase in puts open interest on an OTM strike means strengthening of a support. An increase in calls open interest on an OTM strike means strengthening of a resistance. If the price of the underlying is rising, a decrease in the DOTM puts and an increase in the OTM puts upwards can be defined as an internal roll of the position. The traders are raising the support following the upward movement as a sort of take profit, as in the leftmost arrow. Correspondingly, if the price of the underlying is falling, a decrease in the DOTM calls and an increase in the OTM calls downwards is an internal roll of position, precisely closing of calls in profit following the downward market. If the price of the underlying is rising, a decrease in the OTM calls and an increase in DOTM calls means external roll of the position. The sellers closed the nearby calls and rolled the furthest position, fearing a further rise and leaving the price more room to move up. Sellers protect themselves by rolling the position and moving their risk higher, as in the rightmost arrow. If the price of the underlying is falling, if there is a decrease in the OTM puts and an increase in the DOTM puts, it means that traders are moving the risk lower. The sellers are closing the options they sold nearby, perhaps even at a loss, to open them further away and leaving the underlying price even more room to drop. An increase in the ITM call or put means they push the delta for direction or protection. An increase in ITM put means that traders want the market to go down, and actually they hedge the sold put side in difficulty. Vice versa, upward with the ITM calls, they want the market to go up, and they push the delta to protect the sold calls. This is because ITM contracts are similar to the delta of futures, as they are mostly made up of intrinsic value and a short-time value. An increase in ATM put on the same strike of a call just gone ITM means hedging the violated position with the opposite option. As you can see, the cases are many. With time and experience you will master these concepts without difficulty, and these movements will become more and more clear to you. It is reasonable to study the variation in open interest from one day to the next one. For example, we may see what the operators moved yesterday compared to what they do 2 days ago. But we can also study the difference in open interest of a several days range, as a week of trading, 2 weeks or a month. As you have noticed in this lesson, the daily analysis of variations in open interest allows us to see an entire movie, and not just a picture. We are able to grasp the movement of money day by day, over a longer period of time. If we analyze what happens to the open interest of options each day, we have a goldmine of information for our trading. We can understand how the positions of big traders evolve. We can understand the value, the strength of supports and resistances that we see on the chart with technical analysis. We can understand if that increase in underlying price is going to run out of steam or if it is supported by put sellers. Thanks for watching. See you in the next video.